We are joined from Dubai by Aaron Leslie John, joining us from Century Financial. Hello, Aaron. Thank you so much for joining me. Are you also on the team or the camp that is hopeful about bond markets this year despite the sell-off?
So bond markets, as you mentioned, they have suffered one of the biggest sell-offs in recent times, and T-bills, short-term U.S. government securities, they are at the highest yield since 2006. Uh, so I mean, uh, the bond market investors, I mean, in the recent weeks, they have suffered more losses when compared to the stock market investors. So stock market so far has not reflected the pain or shift in the stance of Federal Reserve. However, this could also be an opportunity for the discerning investor. What we believe is that short-term US securities, which are considered among the safest in the world, they offer a very attractive value proposition for those who want to ride out the uncertainty, those who want to don't face the risk associated with volatile assets. We would suggest investors who are looking for safe haven assets to park their money in US short-term securities, especially the T-bills, as the annualized yielding T-bills are near 5%. The preferred strategy that we would advocate for those kind of investors would be the bond ladder strategy, maybe trying out a ladder strategy with 2 months, 4 months, and 6 months with money equally divided among the different tenors. So there is an opportunity here. Investors can capitalize on this current scenario. If we remember, like a few years back, to get the income, investors even used to park their funds in junk bonds. Now there is no such need. Some of the best securities in the world are offering some decent yields, and there is an opportunity for investors looking for income.
You're saying that you advise to invest in the short term and not to enter into the 2 or 4 or 6 months T-bills. But today we are in the market, we are seeing high interest rate and we are expecting this to continue for the rest of the year, and then we are expecting to see less tightening in the monetary policy, and maybe we can see interest rate drop or be cut. So how do you see the bond market in this context?
So, as we all know, there is a lot of uncertainty in the market. I mean, 1 year back, we were all talking about a recession happening in United States. In the beginning of 2022, by February, we had the Russia-Ukraine war. We had the Fed, which was tightening or like moving at the most aggressive pace in the recent decades. Then commodity prices were rallying, inflation was very high. So there was many economists forecast at that point of time that within 1 year we would be seeing a recession. But so far we have not seen a recession, and the economy at this point of time appears to be much stronger than what it was expected. So to forecast what will happen in the next few months or next few quarters is exceedingly tough. Uh, for those who are not very sure about the future, who don't want to take too much of risk, our preferred way to ride out the risk would be to put their money into the short-term T-bills, maybe 2 months, 4 months, or whatever is a risk profile, and try to ride out the uncertainty in the near term. And when the things become more clear, maybe they can shift to a longer tenure. Again, to answer the second part of your question, we know that the inflation had hit a peak in June of last year when the US CPI came in roughly at 9.1 percentage. Last month, obviously, we had seen the inflation beat the economist estimates, but still the trajectory of overall inflation every month has been declining. Overall, it has been declining, and we expect US CPI to decline in the coming months also. Um, Not due to the economy slowing down alone, but also due to the fact that during the same time last year, we had seen a surge in inflation for the mathematical factor. The high base of last year means that inflation might come lower in the coming months ahead. So we could see the Fed. The Fed is likely to stay at a higher level for a long period of time, but the Fed could reduce the pace of rate hikes. Rather than 50 basis points increments, we could see the Fed increase the interest rate in 25 basis point steps. But at this point of time, most
Okay, Aaron, allow me, Aaron, to interrupt you since we are talking about the investment portfolio and there is some focus on bonds, and we have seen a reversal or inversion in the yield curve, at least on the 2-10 year. Let me ask you, do you think the 60-40 allocation will come back into play because we saw less reliance on this last year? In your view, for the investment portfolio, is the 60-40 the best or ideal portfolio now?
it is ideal. I mean, like a 60-40 portfolio had one of the worst years in 2022, but I think it is more of a one-off scenario. In 2023, the situation has changed. We are not going to see a surge in inflation like 2023. The economic factors also, the economy also is likely to slow down. So we would like to believe that the 60-40 portfolio is ideal, especially because bonds offer attractive yields right now. So for those investors who are looking for some income, a 60-40 portfolio would be offering income protection also. If the bond prices are declining faster than stock market, rotating some of the assets from equity to stock market would help to lock in some attractive yields. So the 60-40 portfolio is a good one for investors in the current scenario.
Thank you so much for having joined us, Aaron Leslie John. You have joined us from Century Financial. Thank you so much. You have joined us from Dubai. Have a nice day.
Same to you. Thanks.